A tax is a form of government intervention, a charge placed on an individual or a firm under punishment of law. The type of tax we're going to be looking at is indirect tax. Indirect taxes are costs placed on goods and services. There can be different motivations from the government behind imposing indirect taxes on certain goods. One motivation can be to discourage consumption of goods that are harmful for the individual. For example, cigarette consumption increases the likelihood of a person getting cancer, which is why consumption is discouraged through higher prices. Now let's look at an example of how this transaction actually works. Say the government imposes a $2 tax per pack of cigarettes. This means that the government gains $2 every time a pack of cigarettes is purchased. However, the $2 expense is divided amongst the producer and consumer. Say the market equilibrium before the tax was $3 with a quantity of Q1 purchased. After the $2 has been imposed, however, the market price increases to $4. This is the $1 expense the consumer pays through an increased market price. Now the remaining $1 expense that makes up a total of $2 per unit tax goes to the producer. This means that the price producers actually receive from the $4 cigarette is $2. See how the producer and consumer each has given up $1 from the transaction. Consumers now pay an additional $1 for a pack of cigarettes, and producers receive $1 less for selling a pack of cigarettes. So the $1 that has been given up by both of the stakeholders allows the government to collect a total of $2 per unit of cigarettes sold. The initial supply curve shifts to the left, meaning supplies decrease due to the price producers actually receive. The per unit tax, which is $2, is represented by the vertical distance between the two supply curves. As mentioned before, from the initial market equilibrium, prices increase to $1, which is the amount consumers pay, and the price producers receive has decreased by $1 from the initial equilibrium. So this vertical distance is the price the government receives from the $1 sacrifice from each stakeholder. And meanwhile, the quantity has decreased to Q2. And since this area represents the $2 tax, or the vertical distance, the price times the quantity would be the government revenue. So this rectangular area here represents the government revenue. And meanwhile, this triangular area here is referred to as the deadweight loss, which is a cost to society created by market inefficiency. This occurs when supply and demand are out of equilibrium due to external forces, which in this case is the tax. Taxes have deadweight losses because they cause buyers to consume less and sellers to produce less, and this change in behavior shrinks the size of the market below the level that maximizes the total surplus. The initial market equilibrium, which was at $3 in Q1, would be the price and quantity that would maximize social surplus. So let's try evaluating the effect of indirect taxes on each stakeholders. Consumers are affected in two ways, by the increase in the price of the good and by the decrease in the quantity they buy. Both these changes make them worse off as they are now receiving less of the good and paying more for it. Producers are also affected in two ways, by the fall in the price they receive and by the fall in the quantity of output they sell. These effects translate into a fall in their revenues, so as a result, they are worse off. The government is the only stakeholder that gains, as it now has tax revenue. That is positive for the government budget. Now the market is worse off as it shrank overall due to the decreased quantity and a disequilibrium caused by the shift in supply. And now here comes a really important concept when deciding who pays more of the per unit tax. This solely depends on how elastic the supply or demand is, meaning how responsive either the consumer or producer is to a change in price. Let's bring back the cigarette example. Since cigarettes are highly addictive in nature, it has an inelastic demand, meaning that changes in price do not affect quantity demanded by a lot. With such a demand curve, a relatively high increase in price does not bring down the quantity demanded by a lot. Therefore, cigarette producers would leave more burden for the consumers of cigarettes, meaning that the price increase is more than the amount producers have lost from the initial equilibrium price. For example, with a $2 per unit tax, the owners can impose $1.5 on the consumers per unit of cigarettes, while the remaining $0.5 can be lost by the producers. Consumers bear more of this tax because producers know that the quantity demanded doesn't decrease by a proportionate amount, so they have the incentive to increase the price more than their burden. Therefore, the more inelastic the demand relative to supply, the greater the burden paid by consumers. Indirect taxes can be imposed with different types of incentives from the government. The first motivation is, of course, to discourage consumption of goods that are harmful for the individual. Some examples can be cigarette smoking or excess alcohol consumption. Taxing these goods is likely to reduce their consumption. Indirect taxes can also be used to redistribute income. Some excise taxes focus on luxury goods such as expensive cars, boats, jewelry, and so on. The objective is to tax goods that can be only afforded by high-income earners. Payment of tax on the purchase of these goods can be collected for the government to narrow the differences with the incomes of lower-income earners. Another motivation would be the government wanting to maximize their revenue. This can easily be done by taxing the inelastic goods, such as cigarettes, as their demands are quite stagnant to price changes. Because a larger per unit tax doesn't bring down the quantity demanded by a lot, the government revenue can be maximized, compared to a good with a elastic demand, which would cause a significant decrease in quantity demanded, decreasing the government revenue. Taxes can therefore have multiple motivations behind them, each of them having different effects throughout the stakeholders.